In today's video, we're going to talk with a mortgage broker and get some of your questions answered. Here we go.
Hi, and welcome. I am Wolf Pierre, the Homestead Warrior.
And I am Angel Pierre, the Bohemian Homegirl. We're realtors with VIP Real Estate out here in, why is it still raining, Colorado?
Why? Why is it still raining in Colorado? This is not Seattle. We are here today with DeLauren. He is a broker with Home Edge, and we've been working with him for quite some time. So, without any further ado, let's get going.
So, DeLauren, tell us a little bit about yourself.
Yeah, so, I'm a Marine veteran.
Army vets.
And
proud.
Anyways, yeah, Marine veteran, played a lot of rugby. So I'm used to teamwork. I love working with people. I love seeing people win. There's a lot of abundance out there, so I think we can all get there. We just gotta kind of help each other get there, want to help each other get there. But yeah, I specialize in multifamily and obviously VA loans as well, and then the normal stuff.
And how long? How long have you been doing this?
So I've been doing this for 3 years now. I'm with Home Edge. I'm a mortgage broker.
And he is quite good at it, I might add.
Thank you. But yeah, I love working for people, man. I love find people the best deal and get them into the home that they love, and kind of starting that process of becoming a homeowner and then hopefully helping them become a future investor.
Mr. DeLauren, what is the difference between a bank and a broker?
All right. So the biggest difference between a bank and a broker is a bank is going to have an LO that works on behalf of the bank. They're going to have a pretty limited options of loans to give you because it's going to be under the guidelines that the bank give you. Whereas brokers, they work on behalf of the client, and they're going to have a lot more options to go to. Myself, I work with over about 20 different wholesale lenders. So it gives my clients a lot more options, a lot more advantage.
How long are the lengths of the mortgages that you guys offer?
So typical mortgages are going to go from about as short as 5, if you want to have a big payment, but a very short amount of time to pay that, as long as even 40 years nowadays. But usually 10, 15, 25, 30 is the different lengths of the mortgages.
So are there any assistance programs that we need to know about?
Yes. So there's some pretty awesome assistance programs out there. The most basic one is probably a down payment assistance program, where they're going to pay for your portion of the down payment. You still have to come with closing costs, but at least that down payment's covered for you. Some of those are repayable. Some of those are forgivable. They're grants. You don't pay them back, but they differ.
Do you automatically qualify, or do you actually have to qualify for that?
Yeah, so each different assistance program is going to have different qualifying factors. Whether it be you make a certain amount of money, or maybe you make too much money for the program. That's something to keep in mind.
All right, so fixed rate versus adjustable rates. What can you tell us about those?
Yeah, so it's super simple. A fixed rate, as it sounds, it's going to be fixed for the life of the loan. It's not going to change anything. An adjustable rate will change during the life of the loan. And that's the biggest difference.
So if it was like 5% 1 year, and then say like the economy got better, and like you administration or something like that, and then somehow they were able to lower the rate, so that means your mortgage rate would change as well as that.
So with the adjustable rate mortgages, usually it'll be like a 5-year period where it'll be lower, which is called like the teaser rate. So it's lower than what you could get in the market. But after that 5-year period, it goes up, and it has a cap of how high it can go up. So when looking into that, I would be very careful. Just be mindful of your situation and what you're trying to achieve.
Don't assume that you're just going to get that top level VP position.
Right.
Okay, so are there ways to lower your rates once you have them?
Yes, definitely. As we know, rates are cyclical. They go up and they go down. So if you go in when the rates are high, just wait some time, and then you can refinance out of that rate, which effectively lowers your rate.
Okay. What about the 2-1 buy down? I've been hearing a lot of buzz about it.
Yeah, so that's in case you're buying a home or purchasing a home, you can actually get a seller to pay a credit to lower your interest rate for the first 2 years. So say that first year your interest rate is 7%. With the 2-1 buy down, it's going to be 5%. And then for the second year, it will be 6%. That third year, it'll go to that 7%. And then it'll be that 7% for the 30 years. But on the flip side, it gives you 3 years to actually refinance out of that higher interest rate and permanently lower your interest rate. So it's a really good option.
And I remember when I was trying to get my first credit card, I know this is like not about buying a house, but when I was getting my first credit card, there was somebody was telling me about hard inquiries versus soft inquiries. Okay, how does that apply?
Yeah, definitely. So a hard inquiry is going to actually affect your credit. For the average borrower, usually probably 3 to 4 points, I would say, unless you have a recent history getting a lot of inquiries, then it can definitely affect your credit. But a soft inquiry will not affect your credit, and it'll let the loan officer like myself get a small insight into your financial background.
So I received a letter in the mail saying that I was pre-approved. Does that automatically make me pre-approved, or can you tell me the difference between pre-approved, pre-qualified?
Yeah, definitely. So pre-qualified in the lending sense, right, is going to be just a general background of your minimum monthly payments, how much you make monthly, and how much home you're trying to buy. I joke around, it's really general. If you want to actually buy a home, you get pre-approved, and that's when the lender pulls your credit, does the asset analysis, does the debt analysis, and actually checks your credit to make sure you're credit worthy to buy that home.
So, what are the basics to qualifying for a loan?
Yeah, so typically we're going to need to see, 2 years of tax returns. Sometimes, depending on the case, you can do one. It's a little more rare. But anyways, 2 years. And then on top of that, they're going to see, 2 months of bank statements. Do you have the money to close, right? Not a surprise. Do you have your W-2s? And really what they look for is consistent work history, right? Have you been working for the last 2 years consistently and bringing in income?
Mm-hmm. What if you change job into a different industry?
Now, the biggest question is, are they going from 1099 to W-2? Is this a W-2 job? Because if they're W-2 and they're switching over into another profession, but it's W-2, it is considered, consistent income, right? Now, if they're W-2 and they just switched into another industry and now they're 1099, that's a whole different circumstance, right? Because maybe they're getting paid commission, now they're considered their own boss. So that can have variable income.
My determination whether I qualify for a home or not is who's my boss.
Yeah, that's a true story. Always a true story.
Like they say in French, c'est la vie.
So can you qualify for more than one loan or just one loan at a time?
You can qualify for more than one loan. So now qualifying for more than one loan means maybe you didn't fit A guideline, but you fit B, which is a different loan program that fits your situation. So you can qualify for many loans.
Finally, this is kind of like a need to know for somebody who's like applying for a loan. What should a buyer not do while their loan application is being processed?
All right, so we're buying a home, right?
Yeah.
And we're in the process. Say we're a week from closing. You're about to get in your dream home, but you just decided to buy that new Benz. To park in your garage. And you know what happens?
It's a Benz now.
I know.
It's a Benz.
I understand. I get it. But you know what happens? Now you don't have a house to park that Benz in because they just pulled your credit. They see that $1,200 monthly payment. And now you can't afford the monthly payment that you had. And now it's over. You just risked all of that for a car.
But it's a Benz though.
So say I'm in the middle of a loan and I'm like, oh, I just got a huge bonus. You know what? I can go ahead and pay off this $15,000 credit card. I have a $10,000, bill that I'm paying every month. Can I pay that off?
Now, this is something you should definitely consult with your LO because they're going to have a better understanding of your situation and if that's going to affect your approvability. Because sometimes it's just based off the minimum monthly payment. It's not off the total balance itself. So that means it's going to be a base-to-base, decision on if you're going to do that or not. But typically, if it's better just to have that money in your pocket before you buy this new home, you can just keep the money in your pocket. All right.
If you liked this video and you want to see more, hit the like button below and subscribe.
We will have new videos posted for you every week, so stay tuned. Thank you for watching, and we'll see you next time.